Last year, the theme of the forum was gearing up for recovery and growth, building a more resilient banking sector. This theme reflected the operating environment we were experiencing at the time, following the emergence of the COVID-19 pandemic. The focus was therefore the challenges affecting the financial services sector in general and the banking and microfinance industries in particular, and also how to chart the journey ahead given a volatile, uncertain, complex, and ambiguous terrain. The last 2 to 3 years have really been quite unique, and they've really been like no other in recent history, with the whole world experiencing one shock after another. It has been as if the Almighty just pressed the reset button and gave us all a fresh chance to start some new things by ending some old ones. As the saying goes, every cloud has a silver lining, and now more than ever, the financial services industry is grappling with fundamental questions about how our decisions to allocate capital affect the sustainability of our communities and the environment that we are custodians of. The COP 2017 Climate Summit, held recently in Egypt, is still fresh in our minds, with several notable outcomes. An example is the announcement of the Trilateral Alliance between Brazil, Indonesia, and the Democratic Republic of Congo, which is the newest member of the East African Community, to cooperate on forest preservation. Who knows what opportunities this green initiative may present for financiers like us? In a similar vein, the theme of this year's forum is Financing for Sustainable Development, a response to the challenges of climate change. Accordingly, the various sessions that will be presented over the next 2 days are designed to engage our minds and our hearts on how the region can build resilience, operate more sustainably, and create economic integration in the wake of the interlocking crises of climate change and the COVID-19 pandemic. Topics over the next 2 days range from green financing mechanisms, currency risk mitigation, promoting agriculture, and impact investment within the SME sector. Delegates are encouraged to take full advantage of the rich menu that is laid out before us. This event is one of the fruits of the strong partnership between the Eastern and Southern African Trade and Development Bank, TDB, and the European Investment Bank, the EIB. TDB is a regional multilateral development finance institution that has celebrated over 35 years of delivering impact across multiple sectors in its member states. Today, we are honored to have the executive leadership of the institution with us. Accordingly, it gives me great pleasure to invite Mr. Michael Awori, TDB's Chief Executive Officer, to give some opening remarks. Welcome, Mr. Awori.
Thank you, James. I'm glad to see you got the memo on the pinstripe suit for the occasion. Officials from the diplomatic community, colleagues from the European Investment Bank, whom we are co-organizing this forum with, Mr. Ostros, Mr. Lombardo and team, officials and colleagues from the finance and banking community and partner organizations, management and staff of TDB, entrepreneurs from our region to whom this forum is dedicated to, fellow panelists, distinguished guests, ladies and gentlemen, good morning. On behalf of our President Emeritus and Group Managing Director, Mr. Tedesse, I'd like to welcome you all to this 5th edition of the East African Banking and Microfinance Forum. To begin, let me first thank EIB for the excellent partnership we've been growing for almost a decade now. In addition to this forum, which we've been collaborating on since 2018, we've been working together to finance critical projects tackling climate action, expand private sector and SME finance, as well as support investment in fragile contexts through over $320 million in facilities extended so far, complemented with technical assistance. Held on an annual basis this past 5 years, this forum has become a landmark event to drive thought leadership around opportunities and challenges in the banking sector in East Africa, as well as the nuts and bolts of its operating environment as it stands today. Dear colleagues, this forum comes at a critical time, as we all know. We're in the midst of what some have called a triple F crisis, marked by food and fuel security issues and volatile financial markets. And this is in a context where we're all still working so hard to make progress in climate and socio-economic development imperatives. Central banks are vigorously raising rates in an effort to contain high inflation. Many currencies globally are also seeing their purchasing power further erode due to an appreciating US dollar. Equity values are falling. Sovereign credit ratings are being downgraded, leading to even higher borrowing costs. And financial conditions are tense in most economies, compounded by tighter macroprudential constraints. In Africa, we're continuing to bear the severe impact of supply chain disruptions. And with an often unfavorable integration into global value chains, we are at greater risk of losing even more value. The global backdrop of these past 3 years has translated across our region into rising inequalities, limited fiscal buffers, and high pressure to contain public debt, while at the same time, there are ever greater spending requirements as a result of the growing economic, social, and environmental needs. It's no surprise then that the latest IMF Regional Economic Outlook for Sub-Saharan Africa, published just this past October, was entitled Living on the Edge. But against this challenging outlook, we must remember how resilient our continent continues to be. Sub-Saharan African output has effectively rebounded to above pre-pandemic levels, and with the exception of 2021, will be at its highest level since 2014, with growth of 3.6% projected this year. Furthermore, for the next 5 years, this region is also expected to continue growing faster than all other regions globally, apart from the ASEAN 5 and emerging and developing Asia. So indeed, in spite of the headwinds, this year Africa is expected to record the second strongest export growth of any WTO region, 6% in terms of volume. As an example of the resilience and agility in responding to the global context, Ethiopia is ramping up wheat production and may even become a net exporter in the coming years. Egypt, one of the biggest importers of wheat in the region, is also dramatically increasing production capacity. In fact, many of our member states, alongside other African countries, are doubling down on their import substitution strategies, and not just for critical commodities like wheat or fuel, but also in terms of manufacturing and energy production, so that more value can be created at home. Following from the African COP27 last month in Sharm el-Sheikh, which was marked by the crystallization of loss and damage as the third pillar of climate action after mitigation and adaptation, as James mentioned, the theme of this year's forum is financing for sustainable development, a response to the challenges of climate change. For our financial industry, it is very important to understand that if decarbonization is not taken seriously through proper mitigation strategies in the rest of the world, the bill for adaptation and loss and damage will be much more expensive for everyone. Being too late on this could lead to a significant hike in the pricing of climate-related risks, the burden of which will fall on our sovereigns, our financial institutions, and more critically, on our private sector and its SMEs, our biggest job creators and the lifeblood of our economies. Climate risk on our continent, which as we know contributes very little to global greenhouse gas emissions while bearing the brunt of its effects, is already adding to our expensive cost of capital. The international community and us, the financiers, must double down on adaptation finance. The challenges of green finance on the continent are quite pronounced, as are those of other important SDG financing areas. And to this effect, taking an integrated approach to help bridge mainstream SDG gaps in a manner that also addresses climate issues at the same time is key. In our case in Africa, this means carefully balancing short-term needs with long-term imperatives. Or in other words, facilitating a just and inclusive transition, responding to both the needs and ambitions of those most impacted by climate change. We must get creative. With huge opportunities before us across all sectors and with a risk-return profile that continues to remain attractive, Africa is what many still call the last investment frontier. A significant amount of additional capital is needed to realize these opportunities. For several years, we've been working hard with various development and commercial institutions to mobilize debt resources to target and scale up financing that address both opportunities for greenhouse gas mitigation as well as adaptation to the effects of climate change. In addition to the EIB facilities I mentioned, we have, for example, a World Bank Regional Infrastructure Finance Facility targeting renewable energy projects in particular, including SMEs in the off-grid sector. However, more capital is needed, including concessional and grant funding, and more equity. We need more institutions willing to put skin in the game. As you know, at TDB, we've been working hard to make African capital work for African development. We now have 20 institutional investors, pension funds, insurance companies, DFIs, and even a sovereign wealth fund, which have invested in TDB. With our consistent track record in terms of performance, returns, and impact, these pioneer African institutions have inspired other investors from outside the continent to take up TDB equity as well. It's estimated that there's potentially up to $130 trillion in assets globally, which could be leveraged to finance the changes we need to see in the world. So it's possible. And at TDB, we're already trying to do our part by providing that risk-return profile that investors are looking for. And this is in our region, where 16 out of our 23 member states are classified as least developed countries, and 9 of them are classified as fragile states. I'm also proud to say that we just formally launched at COP27 a new class of equity, our Class C Green Plus shares, with the African Development Bank announcing an initial catalytic commitment of $15 million, which is already generating much interest from other investors. This is the first equity instrument of its kind to provide a pathway for institutional investors to support climate action and sustainable development priorities with risk capital, with each dollar invested to be leveraged up to 4 times into qualifying projects and transactions. Now, while additional debt, concessional funding, blended finance, and other innovative instruments are needed to better structure and de-risk transactions, more needs to be done to also accelerate the development of bankable, climate-aligned projects. It's estimated that infrastructure, energy, transportation, water, among others, could contribute up to 80% of all greenhouse gas emissions. At the same time, according to a McKinsey report, 80% of infrastructure projects fail at the feasibility and business planning stage, compounded by another 50% drop-off between feasibility and planning stage and financial close. Thus, on top of additional funding, grants, technical assistance, and other project preparation support is needed to tackle matters such as feasibility studies, legal and regulatory frameworks, among many others, in order to deliver a truly enabling environment. Investment-grade international and regional financial institutions, such as TDB, must support the local financial industry so that they, in turn, can support and enrich the entrepreneurial fabric of our economies. As it was raised during COP27, this means rethinking our global financial architecture and even changing some of the rules to price risk in a more intelligent way, as well as to expand financing capacity, particularly for climate finance. Thankfully, global and regional climate alliances and networks are now multiplying, including an African carbon markets initiative launched just last month, which has the potential to be a game changer. So a lot's happening. Through the many coalitions and initiatives, we can hope to align our objectives, our standards, and our methodologies. We must strive to pool our resources together to resolve the most pressing development issues of the day in our region. In this sense, quality partnerships, such as those TDB has had the benefit of developing over the years with institutions such as EIB, have proven vital towards catalyzing support for our short and long-term development imperatives. On this, I wish you all fruitful deliberations over the next 2 days, and I thank you for your attention. James?